Hello and welcome to the Finance Show with William Jackson. I'm William Jackson, your host. And the purpose of this is to explain different concepts and terms and ideas. So this is the Finance Show, but I will be going into accounting and certain principles of economics, corporate finance, and a little bit into investments. So yeah, we're just gonna sit back and relax or take notes, whatever you'd like to do, and let's begin. So I'll start. I have a compilation of different things to include, and at first we'll start off with basic things, and then as the time goes on, we'll move into more complex ideas and terms. So let's start off with something easy like profit. So a profit in a business is when you take the expense that a product has and you add the sale price of that product. So say it costs you $5 to make something and you charge $15 for it, your profit is $10. Now there are different kinds. You can have more in depth. You can have gross profit and net profit. There's really no profit. Those are the more technical terms. And gross profit means the money. It's the profit, which is the money that you make just from a simple transaction. But a gross profit is, I like to think of it as like gross because it's so mixed in with a bunch of different things. It's gross. It's essentially your profit before you deduct your other expenses that you're going to have. Like you're going to have to continue to pay your employees. You're going to have to continue to rent out a warehouse. You're going to have to continue to do certain things. And a net profit is the money at the very end after all expenses have been accounted to, and the net profit is it's at the end. And the company can do whatever they want with this. They can do certain things depending on what kind of company they are, which we'll get into a little bit later. So a loss, obviously, the opposite of a profit, it's losing money. This can happen. Really, there's no business that the charges the charges past the cost, and they'll say, okay, well we made it for $10 and we're gonna sell it for $5. That doesn't really happen. But loss there's different examples. So for example, say you have a company and you have a warehouse full with tons of product that say $50,000 worth of product and only 10,000 of it sells. So you've lost $40,000. Uh, Technically they're in assets, but just on a cash basis, that's what you lost, right? Next we have a security. Security is just essentially an investment. It's really easy to think like you have an asset that's your security. So if something happens to you where you're not secure, you can go into that investment, sell it to the market, and come back, and you can do whatever you want with that money. Okay, volume. This is mostly this happens in there's different definitions. So for accounting, it can be the amount of product that you have, but in stocks, investments, the volume is, for example, you go to McDonald's and you say that you look that there's a volume like 10 million. Now, what does that mean? That means that there were 10 million shares of McDonald's that were either sold or bought. So say you bought 3 million shares and you sold 7 million shares. Combined, it'll be 10 million. That's the volume. And the purpose of volume, knowing that, is to measure volatility in a stock. Okay. So next we have a share price. A share price is determined when a company decides to go public. So we'll get into public and private companies a bit later on. But a share price is simply, so imagine you have a company and you have different certificates. They're called stock certificates, which state that you are the owner of the stock. And the share price is how much you are going to pay for one share of the company. So you can think, okay, well, this company is selling one share, which is a share is just a slice of ownership of the company. So this company is selling a share at $5, and this other company is selling a share at $10. So that really doesn't tell you anything. Normally you'd think, okay, well, I'll go and buy the $5 one because it's cheaper. But actually, that isn't really the case all the time because you have to talk in finance. You have to talk about statistics, to if it's statistically cheap or statistically expensive. So say for example, Berkshire Hathaway Class A shares, we'll get into Class shares later. Class shares, they can be up to past $300,000. So say you think, okay, well that's pretty expensive, but say it's $300,000, but it should be at a price of $1 billion compared to a company that's $5 and should be worth $6. So you think, okay, well this one's cheaper, I'll do it. But really, in this case, yeah, you'd really want to take out a loan of $300,000 if you're going to end up getting $1 billion. There's a bigger payoff. So that's what's share prices. So related to this, Berkshire Hathaway is a good example. So you have stock splits. Now there are forwards and backwards stock splits. So the most common type is a forward split, which means that a company will increase the number of shares by adding new shares to the market. So say you own, they do a forward split of 3-to-1. That means that if you own 10 shares, you'd own 30 shares. So the shares that you own will be multiplied by 3. Well, actually, no, divided by 3. It will be multiplied, uh, the share price compared to where it was before. So a little less complicated. Say you have, example, say you do a forward stock split. This means that the price of the shares will go down. So say a company is doing a 3-to-1 forward split. This means that if the share is selling at $30, it'll go down to trading at $10. So you think, okay, well, my stock's just gonna vanish. I'm going to lose all that money, right? No. What happens is the number of shares that you own gets multiplied by 3 in this case. So you still have, instead of you have 1 and 10 shares, now you have 1 and 3 and 30 shares. So the amount of money that you have invested stays the same, even though this change happens. So why would they do this if everything stays the same? If your interest in the company stays the same. They do this, so say for example, a stock is worth $5,000. Now there are a smaller number of people who can afford to buy a $5,000 share. And the company knows this, and the company knows that they're missing out on a huge market. And that market is people who want to invest but cannot because they don't have just $5,000 lying around ready to invest. So what this does is, say you have $5,000 and it goes down to, say, $1,000. So now it's easier for the company to gain your investors, and this makes a lot of money for the company because it's opening its market, it's expanding the market that is available to buy its shares. So this is just a way for the company, say they're going in debt and they need more capital to continue this, and so their financials look good. So if your financials, you have debt going up, but you have no cash, and it looks bad. So you want to raise cash so you can go into debt some more. So it's more appealing to the investors. Okay. So next we have a FICO score, and this is really fun. This is not complicated at all. This is just what every adult has. It's just a credit score. So a credit score just measures if you pay on time, how much you pay, the interest you pay, how long it takes you to pay, how much, it's just a record of your finances, the things that you bought with a credit card, the things that you put on credit. And this is to make, say you go buy a car, if someone has a better credit score, that means they have a better credit history, then the dealership is more likely to pick them because they know that it'll be a reliable source of income versus someone that has a poor credit score. That's all it is. So now we move on to an IPO. An IPO is in stocks. It stands for initial public offering. So a private company, companies start off as private. They're just owned by themselves. Maybe, really like a little group of people who each own a little piece of the IPO. It's not on the stock market where there's millions of people who can buy. So an IPO, all it is a company declaring itself as declaring that they will have an initial public offering. This means that they will now go from a private company to a public company. And usually what the IPO is, an IPO is just the price and the market cap that the price for the share will be. Okay, so it's very simple. Uh, just the company opening up to investors. Now, sometimes a company, say someone owned, the CEO and founder, usually the same person, will own 1/3 of the company. So 2/3 of the company is being sold. So there's a piece of it, it's not fully public, but it's determined public because it's just not private. Okay? So next we have ICO, which is just cryptocurrency. And I'm not talking about cryptocurrency, but this is the same thing. An ICO is initial coin offering, which is essentially the same thing, but just for cryptocurrencies. Okay. Now we'll move on to the indexes. So first we have the S&P 500, which stands for Standard and Poor's 500. This is a collection of the top 500 companies that are on the market that you can buy stocks in. So all it is, it's just a way to measure growth in the top 500 companies. So say the S&P goes up, then it's a sign that the economy is moving forward because all these businesses are succeeding. Next, we have the Dow Jones Industrial Average, which people just call the Dow Jones. Usually it's shortened to DJIA, but people will just say the Dow Jones. So this is similar to the S&P, but the Dow Jones is there's 30 components of different companies. And sometimes, and just like the S&P, some can be included, some companies can be kicked off, if something, their revenue changes, or if, there was an investigation into it, or there's a lot of speculation around it. There's different reasons can cause the inclusion or exclusion of different companies. So the Dow Jones is just a collection of 30 different companies that are really American companies, and it's just a selection of 30 different ones. And the Dow Jones and the S&P usually they stay on the same pace. Sometimes the Dow Jones will do a little better than the S&P. Sometimes the S&P will do a little better than the Dow Jones, but they're really similar. And lastly, we have the Nasdaq. NASDAQ, the Nasdaq. They're all capital letters, but they're called the Nasdaq, which is essentially the same thing. It's a collection of companies, but the Nasdaq is mainly focused on the tech sector. So most of the components of the Nasdaq are technology companies. Sometimes, usually it'll grow faster than the Dow and the S&P, but usually, it comes back the other way around. Okay, so next you have ticker symbol. So a ticker symbol is, so say for Apple. Apple is a public company, and their ticker symbol is AAPL. So say you go to Google and you want to find Apple stock price. You just type in AAPL and the stock will come up. So when you want to look at stocks, you want to look up stocks, you want to do research on them, you just type in their ticker symbol, and it's really easy for like the computer to understand what you're asking for. And when you're buying stocks, usually they won't want you to say, like, to write out Apple Inc. They'll just ask for the ticker AAPL. A ticker is unique. Sometimes it could be one letter, sometimes it can be two letters, sometimes it can go up to 4 or 5 letters. But it's just an identification for different stocks. Okay, next we have a lien, LIEN. So a lien is something that, so for example, say you take money from someone as a loan and you do not pay them back. They can have the right to take some of your possessions and claim them as their own, and they'll be the owner until you pay that money back. Then the ownership will be restored. Okay, very simple. Next, you have the Roth IRA. So a Roth IRA is a system that is set up by the government to encourage investments. So in a Roth IRA, you can put money into stocks and you have a very low tax rate. The caveat is that you are only limited to say $5,000, $6,000. You can't put in as much money you want and get a tax rate. So there's a cap. But it's usually for investments you can cash out and you can have a very small tax rate when you reach the age of retirement. So it's just a plan. You can sometimes there's little variations about pulling money back like out of it, but really it mainly just stays in the market. It's really not cashed out and given to the owner of the Roth IRA. Next, you have 401k, which is a bit similar. It's a retirement plan that people will take money out of. Well, people will take money out of like their own pocket, and usually through an employer they'll do a 401k, and it's just a collection of investments that will grow, and then when you reach retirement age, you can pull out, and you can have success. So a high yield savings account, same thing as a savings account, regular, but the difference is that it has a high yield, and a yield is say for dividend yield in stocks. A dividend yield is its purpose is to attract investors, but really what it does is say that a company is trading at $100 per share, and their dividend is 2%. That dividend of 2% will be yours. As long as you hold the company, you'll get that 2%. No matter what happens, investors will get that 2%. So say the company goes down 8% in a year. You'll be good. You'll be better off because you'll only be down 6% because you have that cash that's sent to you, or it can be reinvested, which some people, there's really not a majority. But those are your options. You can reinvest it with cash or you can just keep it. So that's a yield. So a high yield savings account is just a higher amount of cash of interest that the capital in your savings account will make. Okay. Next, you have amortization, and this is just like a little table of deciding when you will pay a certain amount. This is for a loan and how much. It's just like a plan, essentially to for your loans for people who are giving you loans. Next, you have assets, and assets are something that a person or company owns outright. So yeah, really, really, that's it. It's just things that you own that have value, usually monetary value. A liability, like mortgages and loans, are the opposite of assets. So a liability is something that you have, for example, a mortgage. You have that money that you have a house and you're living in the house, but it's not yours, and you owe money to the bank which supplied you the money to buy that house with, but now you're stuck with it again to pay your mortgage. So a liability is just the opposite of assets. It's just a subtraction from your net worth. So you have a market cap, and the full term is market capitalization, but usually it's shortened to market cap. And even like if you're searching things up, you just type MKTCAP, market cap. And there's really three terms that are really closely related. So market cap is simply how much an entire company would be worth if they just liquidated everything, they sold everything, they paid off their debts, and you have speculation. But that just creates value in the company, essentially out of thin air, but that's not important. So the market cap is how much money you would have if it all was liquidated. So for example, you can have a company worth say $500 million, um, and that would be their market cap. Or you have a company like Apple, their market cap is over $2 trillion. So if everything were to be liquidated, it would just be a pile of $2 trillion in cash. That's obviously not including money they have in offshore accounts or in different countries. Well, actually, no, it includes the entirety of the company. Okay. Next, we have book value. And book value is just the price of a stock, where a stock should be compared to the earnings and the money that it's making and the expenses. And it's essentially a price that it should be at. Now, what happens is, you can use it to find the price where you should be at. What happens is that there's a lot of speculation. Speculation in finance, it's essentially, say, usually the best example is if like there's rumors. So there's nothing really that changed in the company, but there's rumors that say they're gonna unleash a brand new product for super cheap. It's like super functional. So, but there's just rumors. So because the market hears this rumor, they think, okay, let's bring the stock up way higher. Let's go up to 30% in a day, right? That is really a time to be scared. Warren Buffett, he has a quote. When others are greedy, be fearful. And when others are fearful, be greedy. So speculation throws things off. So the stock, the price of the stock will be up beyond its actual value. And eventually in value investing, there's two types of investing: growth investing and value investing. Value investing is basing your purchase or sell of a stock on the financials of a company. Growth investing is investing on what people expect the company to do. So it's the opposite. It's either a proven track record or what people expect it to do. So when there's speculation, it goes up sometimes. It can go down too with speculation. It all varies, but the book value is that place where you find what it should actually be trading at. That's where you can find that information. But the market always does not, it ignores this. It just does whatever it wants. There's really no way to predict what the market will do. Okay. Next, we have PB ratio, which is a price to book ratio. And this is the price of the stock to the book value, which we just discussed. So it's where it's trading to where it should be trading. Okay, that's where you find value in stocks on the financials and statements. Uh, the 10K, for example, a 10K is a an annual report that a company releases. I don't really think anyone reads them. They're like these super complicated, huge pieces of text, and it's I guess it's essential, but no one really goes through them. But that's what some people use to assess where a company should be trading at. So earnings, yeah, right, earnings. Um, this is when a company reports how much money they made, usually in a quarter. Public companies every quarter of a year, 4 times a year, 3 months apart, they have to report how much money they made to the people, because the SEC, the Securities and Exchange Commission, they're really on the side of the investors, and they want the company to be transparent, and they don't want the public company to be hiding information from the investors, which are everyday people. Well, there's about half of Americans who aren't invested, but there's half who are. Um, so this is just to keep things in order. And next you have the PE ratio, which is the price to earnings ratio. So say you have $100 of a stock and its earnings is $10. So the price to earnings ratio would be 10, because 100 divided by 10 is 10. And this is a method that is used to calculate how the value of the stock. There's many different formulas to calculate the value, but this is the most famous one because it's the easiest to do. So usually what you want to use is you really have to use this between a company and its competitors in the same sector. That's where you usually want to do it, because if one company is overvalued, it's quite possible that the whole sector is overvalued. Same as undervalued. So this means that really 10 to 20 is the general range of where you want a PE ratio to be. And people in finance, we call that the multiple. So the higher the multiple means the more money that you're paying for earnings on those shares. So a lower P ratio is, is recommended. So 10 to 20 is the general range. Next you have the PEJ ratio, same thing, but this time it's price to earnings to growth. So and it's the same. About 0 to 10 would be the good ratio. Next we have expenses. So expenses are just costs that are related in a product or business. Um, they're just costs that are paid and are subtracted from their account balances. Next, we have accounts receivable and accounts payable. So accounts receivable, this is mainly in accounting. Accounts receivable is how much money a a person owes to a business for something that they have used from the business, but they have not paid back yet. And this is a illegally used this is legally used material in accounting. So yeah, you can be illegal with certain things that you do. So next we have accounts payable, which is essentially the opposite. So this is money that a business owes to a supplier, and this is you put it down on your liabilities when you're assessing the worth of a company or part of its financials. Okay, so next we have cash flow and cash flow statement. The cash flow is just how much money is moving around in the books of a company. And a cash flow statement is it's a document that documents documents that lays out how much money is being moved around, which is called cash flow. So next we have the difference between public companies and private companies, which I got a little bit into, but I'll go into depth more. So a private company is a company that you can have employees, workers, but it's not listed as a portion of it is on sale on the market. So they can have like an investor, but since they're private, they're not open like to the full uh, grade of people for anyone to buy from. They do not have to abide by the rules of say reporting earnings every quarter, which is issued by the SEC. They're their own entity and they're outside of that. Okay. Next, we have share classes. So Berkshire Hathaway is a good example because their Berkshire Hathaway Class A shares are trading about over $100,000 per share, and even Alphabet, which owns Google, has share classes. So you can have if you have a certain amount of money and you put it into a Class B share. So a Berkshire Hathaway Class B share is about $200, I believe. So you can say you put $1 million into Class B. You will have, this is essentially for voting power. So you'll have the same power as if you put either $1 million into Class B or $1 million into Class A. But the Class A shares, the owners of the Class A shares are taken more seriously, and their votes are more powerful than Class B shares. So if someone can just afford to buy just one Class B share, just $200, their vote won't be as important as a Class A share, which is usually, well, yeah, they're more expensive. Sometimes Alphabet got really, really close between its Class A shares and Class B shares. This happened for a number of reasons. They're actually Class C shares because Alphabet's Class B shares are private. Um, and actually, when you get really, really close, it's smart to just pull out of the lower class and go into the Class A shares, the higher class. So the higher the class, the higher the letter, A is the more important, and B is less, and C is less, and so on. So those are share classes. So next we have short selling. So we're getting really into the stocks here. It's actually really better to define buying stocks. So you go to a broker, what they're called brokers, and they act as you go to them and you tell them, I want to buy $100 worth of Ford stock. So they do the paperwork and they do all their work and they give you a certificate. And this is more in the olden days. Now this is mostly done online. Um, but they give you something that says that you are the owner of a stock. So there's two terms, there's long and short. So when you're buying a stock, it's called long. You're expecting it to increase. Now, when you sell a stock, when you sell a uh, a stock that you own, so say you have $100 worth of Ford, and you're selling $100 worth of Ford, it's clean. You make whatever money you made. Well, actually, say you sell for 150 because the stock goes up. So you make $50 for $50, and you're set. Now, short selling is a bit difficult to understand, but I'll try to make it easy. So when when you expect the stock that's trading at $100, you expect it to go down to $50 a share. Now, you're not gonna buy it, obviously, because why would you want to buy a stock that's gonna go down 50%? And you can't sell it. Normally you'd sell it if you think it's gonna go down, but you don't have any shares that you own, so you can't sell them. So what you do is something called short selling. So there's long and there's short. Long is buying, short is selling. So short selling is when you sell a stock even though you do not owe it. You sell a stock, you're essentially taking a loan and you're saying, okay, if this stock goes from $100 down to 50, then it's like you sold it at $100 and you're buying it at 50. So it's a little complicated. Um, but essentially, you're selling the stock at $100 because you think it's going to go down. So it goes down, you actually make money. This is the opposite of buying stocks. You buy a stock, it goes up, you sell, you make money. Here, you sell, and then you buy when it's at 50, and it's like if you bought it at $50 and sold it for $100. So this is like the upside down. This is like just the opposite. It's a bit complicated, but it's you can actually make a lot of money short selling. Because just like there can be speculation of a stock going up 30%, so you want to buy it and sell it once it goes up, there can be speculation of, say, companies going bankrupt and their stock goes down 80%. So you make more money in this situation than actually buying a stock and selling it at a higher rate. Okay, so next we have bonds. And a bond is an investment. It's a different form of investment. So there's treasuries, bonds, CDs, which I'll get into right now. So a bond is an investment that you typically it'll be 30-year bonds at 3%. What that means is that you will not be able to get your money back. But in 30 years, it is guaranteed that your money will double. Okay? So there is no risk. So people like to use it, but you really do not make a lot because even if you just do the average of the S&P over the past many years, you have 7-8% average rate of return on investment, return on asset. And since of the way that it works, usually they're for younger people because usually people use this for retirement when they don't want to invest in the stocks because they think it's risky or whatever reason they have. But the S&P, just put in your money, low cost. index fund, very small fees, 7, 8%, you'll achieve way more than 100% return with just a bond. So for example, if you're doing a bond, 30 years, 3%, it'll double. Say you put $1,000 in, you go from $1,000 to $2,000. Okay, sure, pretty good, but like 30 years, really, you want to put more. So say you put in like 10,000, 10 to 20,000. The more you put in, the more you get out. But say for just $1,000, so with a bond, it would double to 2,000. Now, if you put $1,000 into the S&P and just let the economy do what it does, even through recessions, you're just putting in money through corrections, depressions. A correction is when a stock goes down 10%. Usually it's the broader market. When it goes down 10%, it's called a correction. But a recession is like down 30 points, right? 30 percentage points. So say it goes up, you just leave it alone, you leave it in the S&P. In 30 years, you'll have over $10,000 from that $1,000 stock. And say you put in $10,000 in a bond, this will become $20,000. But $10,000 just in the S&P for 30 years will be worth over $100,000. Just $10,000, and you leave it aside and you just let it go, you'll have over $100,000 at the time that you're ready to retire, even earlier. So it really, my advice is to if you're older, then there's different ways. So like when someone asks me, well, what stock would you recommend? You can say, well, I don't know, because say I need to know how old you are, because if you're older, you want to make less risky investments. If you're younger, you can afford to make investments with more risk. And say if you're older and you want a 5% return and in a year, and you're older, so that means you can do a 5% return. So say a company like Caterpillar. Like Caterpillar, I think would do that. This is just an example. But if you're younger, you think, oh, that's maybe try Tesla or something, which Tesla would not be a very wise investment. Uh, Coming from a value investing, I practice value investing, and that's not really so hot right now in the value investment world. Um, but you'll succeed. Okay. Next, we have CDs, which are certificate of deposits. Also similar. They offer their investments offer low rate of returns compared to stocks. Okay, so now we'll move on to treasuries. So when someone says treasury, they're actually referring to the United States Treasury, and a treasury is just say a company, the United States. This is the United States. These aren't companies. Say the United States, we go into a horrible depression, and so like everything is gone. What will happen is that, say something like China, because we already owe so much to China. China will say, okay, we'll loan you all this money, but you'll give us treasuries. So China is making the investment into the United States by buying treasuries. So the United States is getting money, but we're gonna owe that money to China later on when we're better, when we're in a better situation. So those are treasuries. Compound interest. Einstein called it the eighth wonder of the world. Compound interest is essentially you would have exponential growth. It's a function. So compound interest simply explains. So say you have $100 and your stock goes up $10. 10%, you make $10. So now you're at $110. So now you're going to go up another 10%, right? But instead of adding $10, because $10 is 1/10 of $100, now 1/10 of $110 is $11. So you're increasing by the same amount. You're increasing by 10%, 10%, 10%. But the money that you're making is increasing because there's more capital to start with. Okay? Next we have net worth, which is just all a person's assets minus their liabilities is their net worth. So assets, you can have stocks, you can have jewelry, you can have art, you can have all these different things. Minus their liabilities like credit card bills and their mortgage and loans and personal loans, or you have a car loan or different loans, or say healthcare, whatever. And then next we have asset allocation. Asset allocation is pretty simple. It's just a determination of where uh, of what like your portfolio. In stocks we call them portfolios. A portfolio is just a collection of your investments. So asset allocation is saying, okay, I have 20% of my money in this house that I own. I have 30% in these stocks that I own. I have 10%. It's just like you're just looking at where your assets are, where your money is. Okay. Capital gains. We're approaching the end here. Capital gains simply means how much money you have made from investments. That's all it means when you're filing your taxes. Capital gains is just how much money you made with the capital that you have. So there are different tax rates. It depends, with new presidents and with like the Congress. There's so this rate it varies so much because it can change greatly. So like Donald Trump, for example, when he was president, the capital gains tax went down. But when you have a liberal president, they usually go up. And this is it's just how much money you're making with your capital. So next we have tax brackets. There seems to be in a lot of younger people, even there have been even teachers I've had who do not understand how tax bracket works. Several teachers I've had that do not understand how tax brackets work. They should not be teachers if they don't understand how tax bracket works. So one time I had a teacher who said that he was offered a raise of $300, but he denied it because he thought, well, if I make this extra $200, I'm gonna move into a higher tax bracket, and I'm gonna be taxed more because I'm in a higher bracket. So I'm gonna be taxed more than $200. So they think, well, I'm gonna lose money if I take this because they'll give me the money and I go in a higher tax rate and I'll be taxed and I'll lose more money. This is not how it works. Tax rates here are proportional, which means, for example, from $0 to now about $10,000. The money that you make, say you make $100,000 a year, the first $10,000 are not taxed at all. There is a 0% tax rate on your first $10,000. Now you're not going to say, okay, well I'm in the 24% tax rate bracket because I'm making $100,000 a year. That means all my money is going to be taxed 24%. That is not the case. Between your $10,000 to $40,000, you will be taxed at 12% on that amount of money. Just from the 10,000 to the 40,000 will be taxed at 12%. Now from 40,000 to say 170,000, it'll be taxed at 22. Well, actually, no. So you can file income tax if you're single, or you can do tax as a married filing. So say you make $10,000 a year, but you'll still be in the tax bracket if you're making $20,000 a year, but your spouse doesn't work. So it all just depends on how if you're married and how you're filing. So say you'll be in a 22% tax bracket from 40,000 to 90,000, about 90,000. So from 40,000 to 90,000, that amount of money, all that money in between will be taxed at 22%. Now say you make $100,000 a year, after the $90,000 to $100,000, that's where you'll be taxed 24%. So it's a little complicated, but this is, how it works. So my teacher, he said, if I moved into the next tax bracket, really what would happen is the money past the top of the tax bracket you're in, you would be charged say 20% on that. you're not going to be in tax, 22%. If you raise your tax bracket up, you're not going to be taxed 22%. 10% more than what you're already being taxed, which would actually be double if you're just looking at your financials. Okay, you you would be being taxed at $250, just 24%. So say your amount would actually, your raise would after tax be $150. Okay, so you would not lose money when you are offered a raise. Take it because that is not how it works. But they're proportional. So that's how it is. Next, you have GDP. GDP is this is more economics term. So GDP stands for Gross Domestic Product. Now, what is that? That is just the amount of money that the United States, usually the United States, but this can be for any country, makes. This is the value of everything in the United States if it were all to be sold, right? Okay. GDP, very not so complicated. GNP is gross national product, which is very similar, but you're just adding net income the United States makes from trade or different things. Um, GDP actually a good measure of investment. If if the overall value of a stock market is past GDP, stocks are overvalued. This means that you really should not. I mean, if you really want to do stocks, you have to trade. You have to trade even if it's overvalued by 200% or if it's undervalued 20%. You have to trade if you want to make a living doing it. But really, you don't need a whole collection of 50 stocks. You just need a good maybe five, and they'll take you really far. You just have to pick the right ones. Okay, so there's this very example. Um, if someone told you, I will buy you any car you want, any car, but that's the only car you're going to have for the rest of your life. You're going to spend a lot of time thinking very hard about which car you want. And you're going to say, okay, this is what I'm looking for. I want it to be have sight, or I want it to be safe, have bells and whistles, if I want different, cameras, or if I want heated steering wheel, like whatever. You're just going to think about it because you just have that. That's all you have. And you only have one mind and one body, one soul. And you have to take care of it. That's what stocks are. A stock is not, you cannot view a stock as, oh, this is what the market cap is. This is what the price is. No. When you're investing, you have to look at what it represents. So Coke, for example. Some people on Wall Street will look at Coke and think, oh, they have a high multiple, earnings multiple. They have poor earnings, they have debt. But imagine owning Coke. Imagine owning that. Something that brings joy to so many people. There are over 1 billion servings of Coke products every day. And having a piece of that success, having a piece of okay, I'm gonna buy a Coke and I'm gonna give it to someone and I'm gonna make them happy. Having a piece of that happiness is what it's about. Having investments, you can't just look at the numbers. You have to think about their management. You say you have good numbers now, but a recession hits, how is the CEO going to handle it? You can't tell what's going to happen to a company if you're just looking at their paperwork. You have to look, okay, say there's a recession, what will the CEO do? What will the board of directors do? If they want to keep the company safe, and they've proven to do that, that's what you're looking for. You're looking for something that I do it for something that makes me feel whole. So I love American made products. So I love owning shares of Ford. I love the story of how McDonald's came to be. I buy McDonald's. I buy Coke because these are companies that represent the values that I have. They represent strength and grace. And I'll tell you, if I'm feeling bad and someone buys me a Coke, that's the best thing they can do. They take me to McDonald's, they buy me a Big Mac. Woo! I'm getting ready to marry you. I will marry you right here, right now. And you can't explain that. You can't work that out on paper. Oh, that's my speech. But you have to learn. You have to learn it. Investing. I've been doing this since I was 9 years old. For 8 years, I've been doing investments. And really, the truth is, there is no formula that tells you a stock is going to do this. There is no formula. There can be an indicator. Okay, well, maybe they made money over the past year. Maybe they'll do that. But there's no certainty. And the best investors in the world, that's what they say. That everybody agrees. From a poor little investor who has one share of Ford, $10, to the biggest investor, institutional investors, huge mutual funds. There is no set way to do it. There are so many different ways. Now, I pick value investing because it's just logical. Like, it's hard to explain, but you're using stuff that's happened before to predict what's going to happen. So it's all chance. And well, I don't mean like it's not going into a casino, although sometimes when it's really overvalued it can be. But if you stick with a company through thick and thin and you love it and it loves you, you'll be very successful. Very successful. But you have to stick with it. And you can't get emotional when, say, Coke reports bad earnings, goes down 10%. You have to stick to it. If that would happen to me, honestly, I would buy more. Because down 10%, that means there's a discount of 10%. I'm going to buy more of it. There's a discount. Of course I'm going to buy it. But that's not what it's all about. You have to have discipline. It's very hard doing this because it's so easy to get discouraged. But you have to learn what I do when I'm like feeling like, oh my God, the market. What I do is I check stocks once a week so that I'm detached. Like I see a company go up 3%, like, oh my God, I'm gonna buy it right now. Like that's not the way to trade. And it's not trading. Trading and investment are different. Trading is for people who just want to impress their boss with having a good return in a year. Investing is owning a part of something that makes people happy. Investing is providing. Investing is providing. Another great example is someone right now is sitting in the shade of a tree that was planted 20 years ago. Investments, this is my job. So what I'm going to do. And I can assure you it can be very rewarding. And feeling you have feeling that you participated in something that makes someone's day better trumps, oh, I went down a couple points. I can tell you from personal experience. I've been doing this a long time. I know everything about it, every aspect. I've got it down. And I can tell you this. I hope I didn't lose you. Dividends. There's a couple more things, but I'm not gonna talk about that. But dividends are the last thing I have here. Dividends are, I already explained. They're there to attract people. That's what investments are about. Getting together and even like not physically, but you're pooling your money with other people, with other real people who are planning to retire and save up for their kids' college. That's what it's about. If you just want to trade and just bet on horses, it's that's really, you have more risk, have more reward. Just do that, or make bets on UFC fights. Understanding economics and finance and accounting, that eventually you have to look at it, but it's a very small minority of the time is spent doing that, evaluating that. Well, actually, it's a lot of time, but it it is far inferior to the feeling I have when I see someone who exploits, they're going with their girlfriend or boyfriend, they go out, they buy a Coke, and I feel like I helped that. I helped them. I helped them feel better. And you have companies like Ford. Ford's been around for a long time. They're American made. I love American made products. That's what I believe in. I believe in America because that's where I'm from. That's where I live. I've always lived here, and I have to work to make this place better, and I do that by investing. I'm investing in American products to pay help them help research and develop better products for people to have safer cars that can save their families if they end up in an accident. Everyone says, "Oh, who's at the top of the company? Who's at the top? The CEO." Wrong. It's the investors. The investors are the most powerful force in virtually all of business. Owners can fire a CEO like that, and the investors get a bad rap. I think people think, oh, they're greedy and they just want share buybacks and they just want to increase their dividend to keep their investors happy, which is true to an extent. I'm not saying it doesn't happen, but even I'm not talking about institutional like billionaires. I'm talking about like the average person, the average person who just want to make a difference. I know I skewed away. I should start an actual podcast. This is fun. So we covered finance, accounting, economics, corporate finance, investment in securities, profit, loss, security, volume, share price, stock splits, Fico Score, IPO, ICO, S&P, Dow Jones, Nasdaq, ticker symbol, lean, Roth Ira, 401k, high yield savings account, amortization, assets, liabilities, market cap, book value, PB ratio, earnings, PE ratio, PEG ratio, expenses, accounts receivable, account payable, cash flow statement, difference between public and private companies, share classes, report earnings for public companies, SEC, short selling, buying stocks, treasuries, bonds, CDs, compound interest, net worth, asset allocation, debt, capital gains, tax brackets, proportional tax brackets, GDP, GNP, and dividends. Wow, you learned a lot today. But you shouldn't be intimidated. This is virtually all that there is. Uh, well, I hope you learned something. I hope I did a good job of teaching you. And I'm not teaching, reading from a textbook. I'm teaching with my experiences. And I hope that listening to this helped you see a little clearer. Well, this has been the Finance Show with William Jackson. I'm very happy with this, and I hope you are too. Okay? So we meet again, old friend. Bye.